In this week's video, we'll answer the question, are the bulls and bears about to resolve their standoff? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500. If you follow us on Twitter, you know that we said this is not a bad place to consider taking some profits. Here's why. Resistance, resistance, lower high, resistance, lower high. This is looking vulnerable here. Not a disaster though. Haven't really broken any significant levels. The reason why it makes sense to consider taking some profits here is we'll know very quickly if we get a resolution here. If we need to redeploy our cash, we'll know it. All we have to do is clear 2120. And here at 2050 on the downside, if we break these levels here, we could accelerate sharply to the downside. So there's not a lot of risk in raising some cash here. We can either redeploy it or cut further. We can see the same concepts on the weekly chart of the NYSE Composite as of the close on Friday, April 17th. If we're able to clear resistance, and we were not able to clear resistance this week at a similar level, then we can redeploy cash here because we still might get a sharp move to the upside. Our window on the downside, though, is shrinking. We don't have much room for risk in here. If we break into this level here, again, things could deteriorate quickly. Our profit taking was the first incremental step to acknowledge higher risk. We'll shift gears quickly here to the concept of profit taking. Clients know if you owned XHB and this was a position-based move, we sold it and redeployed those funds into the emerging markets. We used VWO. On a relative basis, so far this week, it worked out. EEM outperformed XHB home builders by 2.48% this week as of 10:16 a.m. on Friday, April 17th. Same concepts. Chess move A was to sell VV. Chess move B last week was to redeploy it into ACWI. As of 10:19 a.m. on Friday, April 17th, it's worked out in our favor so far, with ACWI outperforming VV in the last 5 trading sessions by 0.36%. Similar concepts this week from a profit-taking perspective. If you owned IBB, and not all clients own it, you know we have a very, very nice gain. You can see on the weekly chart, we may be making a lower high. This chart still looks good, so a logical question would be, why would you consider taking some of your profits in biotech? If you were to ask me, is biotech a good place to be? The question really should be, is biotech one of the best places to be relative to all the options for my capital? And in this case, biotech still looks good. However, it's getting a little bit long in the tooth possibly. We don't want to push our luck when we have double-digit gains. Also, from an opportunity cost perspective, IBB relative to foreign stocks here. Momentum clearly in favor of IBB on the weekly chart. Something's changing here. We've got much weaker momentum. That doesn't mean biotech is dead in the water. That's obvious because we kept some of our position in most accounts. But what it does mean, the probability of this continuing in favor of biotech is lower today than it was here, 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 or here. Thus, it might be a good time to consider redeploying some of these profits into a more attractive risk-reward opportunity. Same concepts here. We took some money out of small caps, not all of it, and locked in some nice gains. And again, gains have been hard to come by in calendar year 2015. IJR in isolation doesn't look that bad. We have a little bit of a lower high here, but for the most part, this still looks good, and that's why we still own some small caps. The rationale for taking some of those profits and locking them down is also based on an opportunity cost analysis. IJR, the position that we sold relative to foreign stocks VEU, these are ETFs. You can see we have support in favor of IJR. We broke support this week in favor of foreign stocks. We have a bearish moving average crossover. Momentum has been strong relative to IJR in IJR's favor. Momentum is weaker now for the ratio than it's been in quite some time, telling us that the probability of bad things happening is higher today than it was here, or even here. If you look at your current allocation and you ask yourself the question, would it be better for us if the stock market went up, down, or sideways relative to what we own today and what our next chess moves might be? The reality is you really shouldn't care. If you feel comfortable, we can handle it if the market goes up. We can handle it if it goes sideways, and we know what we will do if it goes down. Then that tells you, A, you probably have a good system, and B, you're probably allocated properly for the risk level in the market today. And that's how we feel now. We don't have a preference as to where we go from here. We can see lower highs here on the weekly S&P 500 chart. And again, raising cash here means we don't have to wait very long, potentially, to see a resolution. If we break into this area here, we can redeploy that cash. If we break into this area here, we may have to reduce risk further. Why did we only take an incremental step away in terms of locking in our profits? The answer is the big picture still looks pretty good. There's nothing alarming that's happened on this chart yet. Relative to these moving averages, the present day on April 17th still looks a lot more like this favorable period in 2009 than this unfavorable period in late 2007 and early 2008. How do our market breadth charts look? 2007, the same chart in 2015 still looks pretty good. There's a however coming. Notice the slope of the line is starting to flatten out, which also speaks to slowing momentum and higher risk. Still looks good, but the risk of a reversal here is higher. If you want to pause your video player, you can compare this chart to the present day. This is a concerning look. Now we've just added the volume component into breadth, and this is the exact same indicator on the same time frame as of the close on Friday, April 17th, 2015. This chart looks good for the most part. That's why we only sold part of our biotech, and we still own some small caps. We took an incremental step away. However, with the market not having much room for error, the fact that this line is coming down now tells us the probability of even a short-term decline is higher. Support is very, very close by, so we don't have much room for a short-term decline here, which was another reason why it made some sense to lock down profits. Just updating the weekly VIX chart that we looked at last week. No major red flags here. We don't have a higher high, but we do have a little increase in fear telling us that the probability of further declines is a little bit higher than it was this time last week. We always look at the weight of the evidence, and the weight of the evidence for the most part still looks good, but it doesn't look as good as it did even a few days ago. Here we have another failed breakout here. We broke out, we closed above this dotted line, and then on Friday we came back down below. We've got white space here that could potentially be filled, and if we need to redeploy our cash, we'll know it relatively soon because we'll stay back above this dotted line. And if we do, we could still see some significant gains. We just want to keep clients and viewers up to date. All of these levels are still relevant And if we get a close in this area here, we would most likely consider taking another incremental step away based on the rules. These levels here are the ones that are still more important. If you'd like to study these charts in more detail, you can use the pause button on your video player and then just hit it again to start the video. This is risk on stocks relative to risk off bonds. This is what a rollover looks like in 2000, 2001. Similar concepts here in the early stages of the financial crisis. The present day still looks better. We made a higher high recently. We've got a little bit of a pause here, but nothing overly concerning. And that's why we still own stocks and we're willing to be patient to see how things play out. NYSE Composite Weekly, you can really see the rationale behind we should have better information very, very soon. We're either going to break here or break here at some point. We're starting to run out of room relative to this pattern here. These three charts can help summarize the concepts of things don't look that bad, but we're more vulnerable. Equal weight S&P 500 relative to the S&P 500 still looks healthy, and this tells us that we have a broad-based advance in terms of sector leadership. That's a good sign. Small cap growth is still outperforming SPY. That's the good news. The bad news is you can see momentum is slowing here, and we've got this white space making this more vulnerable. Percent of NYSE stocks above their 200-day moving average supports the theory that we should be getting better information soon. We'll either break to the upside here, or if we move into this area here, we could fall relatively fast in a bearish manner. As always, the markets are willing to guide us if we listen with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.